Do you want me to take that?
Yeah, Shikha, why don't you just jump in?
All right. Okay. Sure. I think what has been very interesting to watch is, I mean, we should watch the U.S. for example. I think it's, on the oil front, it is a marginal, it's the marginal molecule that leaves the country, kind of comes in. It's the swing molecule is how they kind of look at it from a global balance perspective. And from a gas perspective, it's a big contributor into the global LNG market, and it clearly has a great demand source in the United States itself. And what has been interesting to watch from the supply side is the restraint that has been there particularly from publicly traded companies. Since 2020 with COVID-19 and the downturn in prices, and even before that for natural gas producers in 2019, it was very difficult for gas producers to find financing, but there has been a shift in sort of sentiment by the investor community on whether they really want to put their dollars into hydrocarbons first from an ESG perspective. But the second part is, here we are with low price commodities in 2020. Is it really worth it with WTI going to negative? Is it worth it to really, do you get the return that you need? And I think that sort of sentiment has carried through, and we've talked about it time and time again, but this has been the first time I've seen the investor community actually very strongly encourage producers to limit their production because they should become healthier from a balance sheet perspective. And when that occurred, what you found was that production growth in the US from the oil side, from the gas side, has been minimal relative to what we've seen over the past 5 to 6 years. And I think that's been a great contributor and a big contribution to the idea that we're seeing on the supply side, at the very least, some tightness in the balance. Autumn, do you want to talk about on the demand side what you're seeing?
Absolutely. So maybe just adding a little bit on the supply. If you look at the gas point of view, you have the dry gas that's coming from the Northeast versus you have also the associated gas from the oil basins. And with the impact that Shikha just mentioned, there just hasn't been a ton of oil drilling in 2020 and even 21 till now. And that really limited the supply of what we call readily available gas production. And then if you look at the demand point of view, for the past few years, despite so where's the natural gas being really used, right? So it's not the utility or the industrial section that really has gone through a ton of demand shift. It's really the unconventional gas that's leading to the growth of the LNG and the Mexico export. And what's been happening is that despite the a ton of capacity that's been built, I was talking to our clients on why US Gulf Coast LNG is running at 50% utilization, in December of last year. But you can now, with just the overall shortage of the supply plus the spike in the demand, so now US Gulf Coast LNG is operating at almost 100%. So that really created a demand increase, almost 10% of the total demand from the North Americans point of view.
Autumn, when was that time period when it swung back to that when it swung from 50 to 100, just to put it in perspective for everyone?
Yeah, so if you look at our view is from the US point of view, not the Canadian, is last summer was around 40%-ish.
Wow.
And then now we're at almost
back full capacity utilization.
That's right.
Shikha said something that on the supply side that I don't want to leave just yet, which was that we've never seen the investors show the kind of discipline they're showing. And what's interesting when you frame it that way is we certainly heard him talk about that kind of discipline in, say, 2017. So what is different? I don't know, Autumn, if you want to start, what is different about about investor sentiment and the supply side behavior and the sort of organic marginal supply that the US typically provides in the global market now, as compared to, 4 years ago when they were saying sort of the same thing.
Right. I think there's a, like, as Shikha mentioned, there's a real shift in how investors are looking at the industry.
Mhm.
So 4 or 5 years ago, when many of our clients and industry players were interested in what we call green ESG agenda,
Yeah.
It was almost kind of nice thing to do in addition to their normal day-to-day operations.
Mhm.
Today, like the announcements that you're seeing is vastly different. Like they're making public commitments in decarbonization. Look at the example of the Shell, right? So, and many of even independents in North America are making public announcements on how they're going to decarbonize their operations. So there's a real sentiment fueled by the overall support from the policy point of view. So whether it's the Biden administration really pushing for energy transition, or some of the commitments that's been coming out of the COP26, like there are overall sentiment from the government agencies that like we are making some real shift and supports.
Okay, so we're seeing, maybe in the past, ESG was kind of like, and this would be nice to have if our other priorities work out. Whereas now we're seeing ESG be a objective in its own right. And Autumn, you mentioned sort of the policy push. Shikha, can you talk about actually the investor side push for that? Are we seeing sort of setting aside policy altogether? Are investors demanding this regardless of where policy is going, does it seem?
It does seem like that. I think Autumn hit it on the nose with the fact that there was this sort of in 2017, it was for a little more lackadaisical. It was like, that's great. That's an awesome add on to what you're doing.
Yeah.
But around 2019, you started to hear announcements, and this is before COVID, that you started to hear announcements regarding, financial institutions such as JPMorgan, such as BlackRock, coming out and explicitly saying that, we're going to start to assign in our financing, not only are there these financial metrics that you must meet, in order to finance through a loan or through an equity investment or whatnot, but also there are this ESG movement, this environmental, social, and governance kind of metrics. So these boxes that had to be checked. And I think that was an interesting, when you started to see the financial institutions push that way, it really was an interesting thing to watch. It was tight, and I think that the financing was tight then, but where I think things kind of really took off was in 2020 during COVID, and there was just this big surge towards green, clean, where to put the dollars, the stimulus dollars everyone's getting, where's the right place, Tesla's moving up, and stock price. And I think that this sort of momentum, where I thought it was a wave coming in 2019, turned into a tsunami in basically in 2020, and it hasn't really left. And I would say that even if we had some sort of policy kind of pullback, which I don't believe is going to be the case in this administration, as clearly is being shown by some of their actions. But even if we were to have that, I do think that there is an investor space that is strongly committed in making sure that there's responsibility that needs to be taken by the hydrocarbons community. The one thing that I will say that the tone has started to change a little bit, given what we're seeing with pricing, the impacts to the economy, to consumers, is that we're hearing some, not all, but some people kind of perk up and say, yes, we should be decarbonizing. Yes, we believe in it, but it should be done in a responsible way.
Yeah.
And, there has to be the ability to be able to switch over and transition without harming the economy, without harming consumers from a financial perspective, or even just outright making sure you can heat your people during winter, So I think that sort of tone is starting to happen. but it doesn't feel like US EMPs are going to be allowed to abandon any sort of ESG movement that they've already initiated, and they should probably be going forward with it.
Yeah.
And maybe one thing to add is, so we talked about kind of our industry players' point of view and financing and government. What's really different this time around is how is the customers really feeling? So like as an individual, a lot more people are demanding greener products.
Right.
A lot more end market industries, like the consumer packaging industries, are making public commitments that they want greener products. And at the end of the day, all these industries are connected. So in order for these consumer product companies to produce something greener, it goes all the way back to oil and gas industries, where they have to find a real way to decarbonize their operations and find a greener way of managing the company in order for them to sustain their business as well. So I think that's another real shift that has been happening this
Right.
year.
No, that's really interesting, because it does feel like, the way you phrased it, Shikha, the tone has changed like there. And I think it's a good thing. There's a more substantive conversation going on. It feels like, in some respect, I don't want to be the one to suggest everyone is on board anything in the world that we're currently living in, but it really feels like, some of the early debates of should we be going in this direction or shouldn't we, are kind of behind us, and we're getting into substantive discussions about how to go about this, because this is really happening. That's interesting. And one thing I wanted to go back to was interesting also about this little bit we're discussing here is putting this in context of COVID a little bit, because I think COVID is in some sense hiding what was an underlying trend. I remember in 2019 when Fink and Buffett put out their letters to investors and their letters to their management teams and said, this is the direction we're going. And I recall it, when I was teaching at that time, that featured a lot in that year in my corporate finance class for sure. It was really interesting to dissect those letters. And I do think it's been sort of, I don't know if we appreciate just how important those couple of voices were in the entire investment community actually substantively getting behind that, because of all of the economic and public health turmoil we've been through the past few years. So yeah, that is I really appreciate your guys' insights on that and putting that into perspective a little bit. I want to talk about where we're going at this point. So Sarah doesn't yell at me, because the whole point of this conversation was so that everybody knows who's listening in whether they should go into hedging markets for their winter heating fuels, or whether they can just turn up their thermostats and not worry about it, as we all do in our personal consumption plans. So I'm wondering, what are your thoughts on where we're going? As I said at the outset, we've got about some volatility in oil markets, but they're sort of coming off highs. We've got natural gas markets. Certainly it was, my heater's coming on regularly now. It was 19 degrees or so when I woke up this morning. So natural gas seems to be going in the other direction. Where do you all feel we're headed, and what are the factors driving that?
Adam,
Shikha, would you like to take that?
Okay, I'll start.
Sure.
I'll tell you that I think we're headed for a very volatile and bumpy road from a pricing perspective. When you have this disconnect between demand and supply, and I think when Autumn talked about the demand increases, particularly post-COVID, if you look at the pent up demand that we're seeing, and we're seeing it with supply chain issues that are occurring right now, people are trying to get their cars that they didn't buy. People want to get their hair cut. There aren't enough, people at the salon to do that, and so ultimately, I think that the pent up demand has been significant. The supply restraint has been significant. And so really that lends to a lot of volatility in pricing. I would say that in the near term, where we are is where we are. And solutions, particularly in the US, for example, in the natural gas sector, will likely have to come from weather. So if you have warmer than normal weather, then you know what, we're gonna be okay this winter. If you have colder than normal weather, it could be problematic. And I don't like to kind of throw out like, numbers out there, but when you have a global market that's pricing at $31 per MMBTU, $37 per MMBTU in LNG, and we're sitting here at a comfortable 5, which Mike has pointed out is actually very high for us, and we are connected to that global market. At some point, if we need to save those molecules, we're going to have to start to rise to kind of close that arb that's out and open right now to send that signal to send the molecules. And that's rising prices. So I think in the near term, it suggests that, we're in for a bumpy ride this winter, but I do think what we're setting the tone for, particularly in the natural gas space, is a lot more volatility, where you're going to see these winters start to look like this because there's so much uncertainty on the supply side from there.
Right. Let me stay on natural gas before we talk about oil. Autumn, you had mentioned earlier, and maybe oddly, this is sort of a bit of a north wall, or whatever they called it on Game of Thrones. Sarah, you'll like that reference. That our capacity utilization for LNG export has gone from 40 to 100. So do you think that is going to maybe provide a slight insulation? Because that, as Shikha points out, that's a massive arbitrage opportunity that we should look at as a risk domestically for our prices, even though $5 might seem like a lot. It's pretty darn cheap. On the other hand, unless there's a lot of new LNG capacity coming online, maybe we're walled off a little bit. How do you think about those factors and the risks that Shikha was talking about on the gas side?
So so the short answer is I don't think LNG will quickly solve the potential volatile road that we may be experiencing this winter, right? There is a significant lead time in order for us to actually start operating our LNG capacity. Also, another factor that we need to consider is the storage level. We didn't talk about it, but typically storage also provides that like a bit of buffer as we go into the winter. Unfortunately, the storage level in the US is on the lower side of the 5-year average. And unlike the supply and the demand in the natural gas that has been growing over the course of years, the storage capacity hasn't changed a bit. So that creates the like finite limitations on how much of a buffer you can have. Right. And the fact that we are going into the winter with a lower level creates that much more of a risk on what we are able to prepare for the potentially either really warm with La Nina or very cold winter. So like overall, again, it's difficult to put a number, but like likely the risk factor of seeing much higher volatility is probably increasing. And if you kind of do a rolling average of what that gas price will look like, maybe starting from 2019 to 2025 plus, we are seeing like the spike in 21, and then hopefully it will come back down. But if you look at it from the daily volatility, especially on the winter month, I think the standard deviation is getting much bigger. Yeah.
One of our questions, I think, again, before we move off of gas, was about infrastructure. And even though it was, to some of it was about oil pipelines, I want to actually use that as an opportunity to introduce infrastructure here, because one of the problems that we saw this past winter, of course it got quite cold, but we really didn't have the ability to arbitrage, in electricity. What we're not really talking about here, but even moving natural gas around wasn't that effective this past winter. So can you speak, maybe start with Autumn, on how you think about the capacity constraints in the infrastructure that help us to get through the winter, and what kind of risk factor that poses?
That's another really important aspect of kind of the challenges that we're experiencing in nowadays. So not only building, but even expanding, sometimes even doing meaningful maintenance on existing pipeline infrastructure is getting harder and harder. And despite we have very attractive quality of rocks available in Northeast, like we're essentially constrained in terms of moving those molecules, right? So that's further actually creating that the higher risk or the volatilities on what we are able to access in terms of the like marginal molecules.
Right.
And that situation is no real difference for the crude pipelines either, right? So I'll start from there, and Shikha, if there's anything that you would like to add.
Sorry, I was on mute. Sorry. So yeah, no, I agree. I think infrastructure has been incredibly difficult to come by in connecting. So we went through a period of time where we expanded in infrastructure. We were able to connect the different markets, particularly in gas, and try to really create some fluidity. And that's kind of slowed down, particularly from a policy perspective. If you look at the Northeast, where the dry gas is kind of the leading kind of producer of natural gas, right now there are no new infrastructure projects that are likely to allow these producers to grow. And if you can't get the gas to the right place, the demand's growing. It again sets up this sort of like volatile situation from a pricing perspective. But yeah, I think that, we're having these difficulties from an oil perspective. We saw it with Keystone, Dakota Access Pipeline as well, that there's been some issues regarding those. And I really think that, at the end of the day, the lack of that infrastructure in place really does suggest that there are pockets of bottlenecks, and there's definitely demand portions that aren't probably receiving enough of the molecules, or the carbon molecules that they need.
Right. Yeah. And I'm wondering, and here I'm going to ask you to really maybe speculate at the limits of things that you feel comfortable speculating on. I'm wondering, we were talking earlier about how the ESG conversation is becoming much more sort of substantive, and this is a positive thing. A lot of these constraints on infrastructure, when you think about them, really feel like sort of ESG type of, they're at least framed in ESG terms, where we're going to slow down infrastructure because we don't want to create much demand for this thing that we're trying to get out of. And I wonder if you are at all optimistic, maybe looking out at some of the intelligence you look at, or just in general, how you're seeing the conversation evolve, that as we develop a more sort of mature, substantive conversation about how we transition to a ESG concerned world, does that filter down to some of the conversation about infrastructure? And do we get, certainly not all infrastructure can be painted with the same brush. There are some clear bottlenecks that are going to have huge public payoffs if we can get them installed. Are you at all optimistic on anything in the no pun intended, in the pipeline for infrastructure that might actually solve some of this?
So from my perspective, I am not optimistic. Where I am optimistic is, clearly on the renewable fronts, there's a lot of investment that's going towards that, building out wind, solar, and I understand it. My concern is that we don't have the ability to store electricity on a wide scale, right? We're still waiting for Elon Musk to come up with that battery that, he promised Australia like 3 years ago. So no, and it's great, he's been busy, but ultimately though, I think that, it's very weird to me. So living in the Northeast, I'll give you an example. You buy a home in upstate New York, you want to tap in either to the natural gas grid. You don't want to burn oil, right, for your heating purposes. You can't. No utility will allow you to enter into the natural gas grid at this point. There's no new tap-ins right now because there isn't enough gas that's flowing to the region. Wow. And so you hear this sort of situation happening, and you start to see the disconnects. Yet New York State won't allow Constitution Pipeline, which was what Cabot was trying to put into place since 2014. I think these guys
Right.
were struggling and then they finally abandoned it. But like ultimately that was supposed to feed that sort of market and allow an increase in tap-ins. So here we are in New York City today. Everyone's trying to get greener and cleaner, and we can't. We have to use oil boilers now, and we have to use heating oil number 2, you know? And so like, I think to me, that sort of conversation is problematic, at least in the next decade, right? You know, until you come up with that technological advance from the ESG perspective of what is deemed ESG, which is mostly renewables at this point, right? Until you get that, you're going to be with these mismatches and dislocations, and it takes a long time to get some of this infrastructure into place. A pipeline from the Northeast to the Gulf Coast, where most of the natural gas demand is, from the production point to that point, could take 4 to 5 years. It's billions of dollars. And why would anybody put that money on the line right now with so much uncertainty regarding that infrastructure actually being completed? We have Mountain Valley Pipeline that is essentially done in construction, but cannot run because of regulatory issues. And so I think that that's been a painful process for the upstream and midstream communities to kind of have had to deal with. So I am not as optimistic on the hydrocarbon side. And on the renewable side, I'm sure that we're going to grow it out and it's going to be great, but we do need a technological shift in order to really create reliability on the grid.
Right. What are your thoughts on that dimension, Autumn?
So agree, I think it's going to be really difficult unless some sort of like catastrophic event happens that really changes the mind of the consumers and the policymakers, right? And none of us wants to see that, right? So but I think, at least like from my point of view, is unless something like that happens, I think it's going to be a very challenging battle to actually put additional infrastructure in place.
So something like that would present the opportunity. I'm sorry, I cut you off. You were going to say something else right there.
Oh, no. So, and it needs to be a collaboration, right? From the policymaker, consumer, industry, rather than various interests pulling into opposite direction. So like what will be that mechanism or that alignment of the interest to be established as we are transitioning from hydrocarbon to like more ESG oriented energy world.
Okay, so it sounds like both Autumn and Shikha are counting on Mother Nature to solve this problem. It's all going to be Mother Nature treating us nicely or creating a catastrophe that gets us to work together.
So something interesting that Autumn mentioned, we do have like a actual like situation that occurred in 2011, Fukushima, right, with the nuclear disaster, and you immediately saw responses from Germany to take down all of their nuclear facilities, which is what they're doing today, to rely on renewables, which is interestingly not enough at this point in time because renewables didn't show up this past year. Mexico did the same thing. They scrapped their nuclear plans right after that and decided to go gas. So I think Autumn hit it right there. Like it almost takes this sort of thing to happen. We're not proactive, we're reactive oftentimes.
So Mother Nature, broadly speaking, not just weather, but earthquakes. Okay, so everyone's got that. Keep your vision sort of broadly scanning the horizon for natural disasters that might get us to work together. That's encouraging news, but we don't want to end there. So I want to talk a little bit about beyond that encouraging thought. What do you see the longer term outlook being for where we go beyond, say, this winter? So this winter we've characterized as the supply side is quite tight. We've got these ESG pressures everyone's sort of starting to have a mature, coordinated conversation about, but it's really all going to depend on demand because supply is so tight, we're going to have a lot of volatility and it's either not going to be too bad depending on how Mother Nature treats us or it's going to be worse. Where do you see this shaking on the long term as some of these supply side dynamics, we're able to sort them out. We're able to get through the ESG type of negotiations, get things permitted if we're ever going to get them permitted, things like that. We're able to make demand side adjustments and change our consumption patterns. Where do you see that shaking out in the long run? Autumn, you want to start there?
Yes, it's related to the comment that I made earlier. So if we look at 2000, let's say I'm just putting a date in the ground, like 25 and beyond, when additional like LNG capacity is operating, not only from North America, but like other places. And the pent-up demand is neutralized as we are recovering from the COVID. The overall supply demand should get balanced in coming years. And that means where's kind of going to be the gas price that are going to set is going to be where the operators are able to meet the demand at an economic level. And from McKinsey's point of view, that is somewhere around $3 per MMBtu. Of course, that's a annual average. It will be but it's the economic level where most of the independent players are able to produce sustainably.
So you're saying like the $3 per MCF is that cost coverage number that in a competitive market things should shake down.
That's right. That's right. But like it's not to say that there will be spikes, right? Yeah. So as we talked about, a lot of uncertainties that's increasing over time. Infrastructure bottleneck. That's not just the pipeline, but also the storage and the more volatile weather changes, not just in North American, but like also global. It's all tied. So all of those are adding additional factors for that like risk to be moving up and down much in a larger variations. But like in five-ish year time period, we should be able to come back to kind of that neutral level.
Converge that. How do you feel about those numbers, Shikha? And maybe you can also talk a little bit about oil, which is a little trickier because there are just certain players that decide what it's going to be priced at.
Yeah, absolutely. So on the gas side, I'm with Autumn. I mean, I think, like maybe a little bit higher than 3 might be the number, just kind of looking at the way the publics are, but 3 feels like a comfortable, good baseline right now, just, kind of finding where we can find balance. We do have a molecule to meet all the demand. It's just the willingness to take that molecule out of the ground. And so I think that, that to me makes sense from a fair value perspective. On the oil side, I think what's interesting is you do have other sort of groups that are interested in this, including OPEC and OPEC plus. And recently what we're seeing is that, there's some sort of willingness to kind of hold the course, even though the US has asked OPEC plus to increase, oil supply. They've held the course. Typically, they've always said $80 is like kind of like their point that they like, and they can regulate around that. It feels like at the moment right now, it's a little bit higher, but I think you're going to kind of see a return to normal at that point. Again, at $80, I think a US public producer who is the swing marginal molecule for the oil sector is making money. And I think that there is, especially with healthier balance sheets, there is definitely a road forward for growth in US crude. But I think it's very interesting because at the same time on the crude side, while on the natural gas side, I think we're going to see increased baseload demand over the next decade. On the crude side, we start to question kind of how much real demand is out there, particularly as we transition to EVs and whatnot. So while I want to say, that the typical back of the curve has always been $60 a barrel. And in the near term, I think, there's there's been some interest in the market to kind of think that maybe it's 70 or 80 at the point. It does feel like 60 in the longer term as we keep going beyond the decade will probably be more of an anchor, just because you're not only having the supply side that has to respond, but you have this demand side that might be diminished relative to natural gas.
Yeah, and increasingly when you look further out, you've got, the monopolistic producers, the nation states who are looking at the reality of declining global demand and just saying, do we want to leave this in the ground or do we want to cash it in? Because we're only going in one direction. So there's that that dynamic. Before we move off of this and maybe read through some more of these questions, I do want to ask, so I think that $80 number is certainly a number I've thought a lot about myself. And this is why I sort of jokingly call it the ill-fated battle for market share back in the day. But to not make too much fun of OPEC, you know, the reality is they had allowed prices to creep up to about $100. At $100, what made sense was not just shale gas and all of this stuff that breaks even between 30 and 200, whatever number it is, but actually all the long lead time things in Alaska and the Gulf of Mexico. Where does that $80, let's say we're talking about 80 and then it drifts down, like you said, there's more downward pressure on that than upward in the long horizon. So where does that leave the mix of the upstream? What does the upstream look like to you? Is it all a shale oil type of thing that sort of comes on and off with short lead times? Do we still have some development in the Gulf of Mexico or other sort of big infrastructure intensive type of developments, big fixed costs, low variable costs is the way I often talk about it, whereas the shale stuff is all variable costs to some degree and very little fixed costs once the infrastructure is in place. What do you think the industry looks like if that is the long-term glide path that we're on?
For me, I think that, you know, the longer term. So, okay, here's an interesting data point. Yesterday, the US held an auction for the Gulf of Mexico, and it had a record number of leases that were actually like auctioned for and bid on at the highest levels of prices that they've seen, or in dollar terms. And the majority, what I saw at least, and I was just scanning the article through, but I saw that it was majors that were buying it up.
Yeah.
And it was like an Exxon, Chevron, you know, those were the guys that were kind of out there. And I thought that was very interesting because here you are as a major, and a lot of majors in the US have said, you know what, longer dated projects, you know, we're trying to look at like the health of the company. Shale is not the place that we want to be in right now. They've retracted from shale and they're looking at these longer projects. But it does get interesting to think about, and you bring up a great point, because if we're thinking of pricing pressure and we're looking at a 20-year horizon, what is the longevity? Is there something there? And I think that the only thing that makes sense is if you're the competitive molecule that's out there. If you can prove that you can bring your costs down to a level where you can make money off of that trade, you know, ultimately. And it does feel like places like Brazil, development in Norway, you know, those things are going to probably peter out. And I think that that's kind of the bet that's happening right now, is where US majors are looking at this and saying, we have longevity, we have the ability to hold, we have a vertically integrated structure. Why not bid up on these projects? Look at these projects. Clearly, we're in a price frame that works at this point in time. But in the end, maybe these guys aren't there. And so ultimately, there is going to need to be some supply growth that's meeting some sort of, you know, declines and stuff. And maybe they're filling in that prospect. But I think generally speaking, I would love to say shale is probably like the thing that will stick around for a while, particularly with the independent producers, just because it's so relatively cheap. It's so much easier and so fast to come on and react. It's a big disruptor, right, in the market right now. And so to me, that feels like the thing that survives volatile pricing, right? You know, if you find a way to stay healthy in the low phases in price and then capitalize on the high phases in price, I think that, you know, those are the types of things that I think will stick around for the longer haul, just because of its ease and its ability and flexibility. But there is something interesting going on.
There's something interesting going on. I want to comment on that myself, but Autumn, do you have anything you'd like to follow up?
It's a very interesting data point. It's almost like they're playing an option, right? So, and similarly, at the end of the day, the crude prices are going to be set by the demand. Whether we are looking at how aggressive this ESG agenda is really going to reduce the crude demand globally, is ultimately going to set the prices. And our view is that if that price is somewhere around like 40 to 50 in a long run, then that marginal on and off agile production is going to be coming from the North American shale producers.
Yeah. I was having the same thought, Autumn, that that there's got to be someone who's studied real options investment models who is making this decision. But specifically, what it seems like to me is you could argue if, with all the advantages that Shikha pointed out that shale has, you know, all the cost advantages, the diversity of locations and cost structures, it does, in the very long run, seem like something that's much more burdened by the ESG problems. And if we do move in a direction of having more mature, how do we handle this? What role in the long run does oil play in the global energy mix? It could be a play on a bit of an ESG arbitrage. Maybe the ESG costs just wind up being a bit lower when it's out of sight and out of mind than when it's literally right there and needs a pipeline to pass by your grocery store in order to get it to your house.
That's spot on. I think that's actually a great point, because ESG in one place is not ESG in the other place.
That's right.
That's right.
So we have some specific questions. I know we don't have too much time here. I'll let Sarah just cut us off suddenly, but someone asked if you guys can speak to how you think the new proposed methane emissions rules and limits on oil and gas activities, how they'll affect producer cost and impact prices going forward, maybe over what time frame you think any of that could bite.
Yeah, so from my perspective, I think a lot of the producers that we speak to were already moving towards this direction of methane capture. If you take a look at, oh my goodness, I'm blanking on the name right now, but there's a specific company out there that we just met with recently that literally in their shareholders reports and their earnings reports have stated that they have now captured everything coming out of the well.
Yeah.
But they're doing total methane capture. And I think that, to me, that is something that the market and the model from 2019 forward and how these companies are coming out with ESG plans, this was the first easy, loose, the low hanging fruit that they could do and they could capture. And it's been, I think, while the costs are increasing from that perspective, what we find is somehow shale technology is still improving and there's still efficiencies being borne out. So you're not really feeling as significantly the costs that are out there. And it's something that we're hearing time and time again across the gas space, the oil space. What I will say is, from a methane emissions perspective, it's great, but also now there's a lot more interest in tracking the carbon emissions through the entire life cycle of the process of producing gas, for example. And that, I think, is fairly new. And I think that could actually start to add premiums. And for one reason, no one knows really, there's no one solution on how to do it, right? Everyone's kind of throwing out their own method. It's so brand new right now.
Right.
I talked to one producer in the Northeast, and it's called certified gas, where where that methane from front to back is. And he was saying that he thought it was easily another 20 to 30 cents per MMBTU premium just from that, because it's just so brand new at this point in time. Whereas I think the methane emissions capture, they're getting a handle on it. And I think that sort of thing is actually, it's beneficial to them. And, as long as they capture that methane, they can sell it somewhere.
But one of the things, before I turn to Autumn, I do want to press you, or maybe even Autumn, you can comment on this, is that, there's a diversity, obviously, of asset quality, facility, infrastructure, local field level infrastructure. And what we've seen in some studies is that these assets, they get reshuffled from one owner to the next. And of course, the ones who have a brand value to protect, when you speak to them, they are probably deciding, with the ESG pressures, we may as well collect it all and sell it rather than let it vent. But when it's a field, it seems, at least when it's a field that it's very costly to retrofit and control these emissions, those assets somehow find their way through sales and transfers to companies that don't quite have the brand value to worry about and the the sort of emissions footprint of those assets remains the same. They just wind up being owned by someone else. Autumn, do you think that that will be handled by, say, ESG pressure through the investor channel, or does that fundamentally require some public policy response?
So I'm optimistic on that front. So I think this the reporting on ESG is becoming more common across players, whether you are public or privately traded, and a lot of the conversations that we're having. So if you're an upstream producer, like you have a finite footprint of your drilling or production, and you have mechanisms to monitor and capture. And if you're a pipeline that's going through hundreds of miles, and it's much harder to kind of monitor and capture those like leaks of methane. So like a lot of the conversation that I've been on is, what are some of the technologies that are scalable so that you can really monitor, capture the methane leakage over the course of like a large premise, right? So, and that's something that a lot of operators are already putting some real money behind. So I tend to be much more optimistic that of course, it will expedite if there's a public policy that's driving it, but it's going to move into the right direction.
So even amongst the private equity folks, you're seeing some pressures that are leading to internalize these costs. Somehow the ESG pressures are getting in even when you're not a publicly traded company. Well,
actually, sorry, just one thing.
Go ahead.
It was Devon Energy. I don't know, so sorry, Devon, that I forgot your name. But B, I also agree with Autumn. Just one really quick thing. Right now, while privates are buying up a lot of things right now, the transition that we're starting to see, particularly in gas, is publics buying privates. This is the first time, like in the Haynesville, a private has had the ability to sell, and so they're ready to get rid of this asset completely. And in order for a public to buy it, like Southwestern or Chesapeake, they're going to want a commitment from an ESG perspective. And I think that's the kind of idea that's going to happen, where you're going to have to do it regardless because it's part of the package deal.
That's a really good point. And that's a different way that policy can, instead of being prescriptive, that it can work is just how far back, if this becomes a legacy issue, will the public be able to reach through the chain of transactions? And as long as they can reach far enough back through the chain of transactions, the ESG pressures will come through the transactions. They'll sort of be capitalized in along the way. Well, I'm sorry we have to go. I'm enjoying this conversation, and I hope some of our attendees did as well. I'm sorry we didn't get to all of the questions. I know there's going to be a few more, and I'm going to let Sarah close us out and talk about what's coming next in this program. And thank you all for joining us. It was my pleasure. Thanks, Autumn and Shikha. Really great to see you.
Thanks for the opportunity. Appreciate it.
Thank you.
Well, thanks so much, Autumn and Shikha. We really appreciate the insights. And obviously this conversation can go down a bunch of different rabbit holes for sure. I know I wanted to talk about kind of energy affordability and things like that, but we just don't have enough time to do that. But I think that's why this is a great series, and especially talking about the ESG portion and how that's really kind of driving the markets right now. It's just fascinating to see how it's at every level kind of threaded through the business. So thank you so much for your insights, participation today. Really kind of want to say thanks to JPMorgan Center for Commodities here at the B School as well for their partnership and kind of these topics and everything that we do kind of on the energy related front. Just real quick, just a reminder, our next event is coming up, Winter's Coming European Crisis Part 2. That's December 8th. So please make sure you kind of jump in to kind of hear kind of what their perspective is. What we're going through here in the US is definitely an anomaly, but what they're going through there is certainly hard hitting, and a lot more countries involved in it as well. So it makes it even more complicated than what we have going on here. So would love to see you there. And again, thanks so much for everyone for tuning in, and look forward to bringing you guys some more kind of industry insights. Thanks again, Shikha, Autumn, and Mike for hosting today. We really appreciate it.
Great. Thank you.
Thanks.
Great seeing you. Bye-bye.